Good afternoon, everyone. Welcome to the ABF Consumer Panel. I'll make a brief intro. We are glad you could join us at this lunch hour, so I guess you're going to feed yourself with our lively discussion here. I'm Rajan Arya, and I'm thrilled to be here. I'm going to be moderating the panel. I'm a Managing Director in Private Fixed Income of SLC Management. SLC is the asset management arm of Sun Life Financial, a life co-headquartered in Toronto, Canada. We manage about 60 billion across the Lifeco's general account and third-party money in the private fixed income portfolio across a variety of asset classes, including consumer. Within consumer, you have the credit cards, unsecured, personal, and such. So happy to be here. I'll turn it over to all the panelists here to introduce themselves.
Thanks, Rajan. Thanks, Envisa, for hosting this forum. I'm Saurav Kar. I'm a portfolio manager at Zeiss Group, which is an alternative asset manager, and I'm responsible for both public and private asset-backed securities at Zeiss, and we're involved both in the liquid markets, as well as in the private side, mostly in warehouse lending.
Nancy Mueller-Hando with Bayview Asset Management. I'm head of insurance asset management. Bayview's very focused on residential mortgages and consumer credit. So happy to be here.
Hi, everyone. My name is Eliona Shkreli, and I'm the head of investor relations with Stratus Financial. Stratus Financial is a licensed student lender specialized in financing students who want to become commercial pilots. As head of investor relations, I act as a bridge between Stratus and our valued investors, just making sure and update them on a day-to-day basis on the performance health of the company as well as in their portfolio returns.
Good afternoon. Jason Tepperman, I'm president of JG Wentworth. I lead our credit businesses. We are a specialty finance direct-to-consumer company focused on structured settlements, debt resolution, and consumer credit.
Hi, everyone. My name is Ivy Wang. I lead the capital markets effort at Upstart. We are a fintech that uses machine learning to underwrite consumer products. Our bread and butter is unsecured personal loan, and we're also have new products in auto, HELOC, and small dollar loans.
Great. That's quite an eclectic panel and investors and consumer originators. So hopefully we all have a lot of good things to learn from them. Let's start. I think there is a couple of polls we have. If you want to activate, your fingers, use that to choose your one of them. Choose one of those 4 responses, and then we'll see what the broader audience thinks. But let's start at a high level. The macro factors. I would just caveat this with a couple of things. There is people who love macros. There are people who say macro factors are kind of what they are. Focus on your business and your origination and what have you. I think Mark Twain quote that I like is, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." So with that in background, consumer sector is one of the most pro-cyclical sectors. And one of the interesting trends recently has been this mixed data on the health of the US consumer. You got the unemployment rate that has been at all-time lows, and younger generation, I guess, got introduced to a new word in the dictionary called inflation. And last couple of years have seen a huge hike in rates within a short period of time. Add in, the once-in-a-century pandemic event and what have you, with supply chain issues, bridge collapses, near-term US elections coming up. So a lot on the go. So Nancy, if I can ask you to lead this, what's your take on macro, and how do you look at it in the context of the business you invest in and how they perform?
Sure. So I'd say our view is bifurcated in a couple ways. Very positive on the consumer at this point in time. I think we've seen household balance sheets in great shape, particularly because you have a lot of people locked into very low mortgage rates, which almost acts as an annuity and a tailwind for them over time. And I'd say that even aside from homeowners in general, most consumers are just in better shape because of real wage increases, adjusted for FICO inflation, which is, I think, a topic we're going to talk about, the consumers are generally performing better across all spectrums. So we're pretty positive on the economy, and with what we're seeing in the market right now, not a lot of bumps in the road is what I'd say.
That's great. Saurav?
Sure, thanks. I think Nancy's already kind of touched on some of the very salient points. But I think, the resilience of the U.S. consumer in terms of consumer spending has probably been instrumental in staving off recession over the last couple of years. So on average, we think that the consumer is actually doing fine, but it's been really a story of averages, something that Nancy kind of just spoke about. So while we're kind of vigilant of any changes in the labor market, I think we continue to hold a constructive view. The bifurcation subject that has come up, we think is something that's likely to persist for a while, notwithstanding any of the Fed's rate policy cuts. Because I think the transmission mechanism for what created the bifurcation in the first place is something that's unlikely to kind of revert overnight. By that, what I mean is kind of, when you cluster consumers in a couple of different ways, whether you're looking at homeowners versus renters, whether you're looking at different age demographics, whether you're looking at different geographical demographics, call it Midwest or the South. Historical data analysis shows that these clusters actually experienced inflation in very different ways. And for example, for renters, on one of the largest debt obligation on their balance sheet, they just essentially were like homeowners with a variable rate mortgage who went through a rate hike cycle. So you've kind of seen rate increases of about 30%. So while I think, the tailwinds of wage increases, a strong labor market are a positive in terms of getting some of those cohorts back to their regular purchasing power, their regular disposable income, especially some of the households that spend a disproportionate amount of their income on necessary expenses, I think it's going to take a little bit of time, which is why I think it's important to approach the market with that sort of a value-oriented lens, dig through kind of the data and look at credit that's very attractive overall, but try and avoid the tails.
Thanks. So that's great. Jason, from an originator perspective, I guess, your core product is, I don't know if it's fair to say, less reliant on consumer health, the settlement side of things, but, anything, what's your take?
Yeah, so we're probably a little bit more cautious on the whole. We have three different products we bring to market. One is the structured settlement product where we buy annuities from consumers, and that's really a rates-oriented product. There's not a lot of credit risk in it. We also have a debt resolution product that is more of a near-prime product that is quite sensitive to the consumer in a little bit of a less pro-cyclical way. And then we have a lending product. What I'd say is, I think if we track back to the post-COVID time, there were some more simplistic adages that a lot of folks were looking at. The K-shaped recovery, the subprime consumer is always in a recession, and I think a lot of that does not hold today. Is not a useful guidepost for where we are today. If you think about the different, and we talked a little bit about bifurcation. If you think about the subprime consumer, there are a lot of subprime consumers whose income has substantially outstripped inflation. They're up 30% in their income and inflation was up 20%. There are a lot of prime consumers where that equation is inverted and they are now struggling with higher debt obligations. What Nancy mentioned with respect to home ownership is super critical. You have people who are homeowners for more than 3 or 4 years. They now have $80,000 more equity in their home than they did at the start of this period. They now have a mortgage that has a present value of about $100,000, which they can't monetize, but is an incredibly valuable asset and source of credit support for the consumer. And by contrast, if someone was a renter, they have $300 a month of costs that they did not anticipate having just a few years ago. So we see a lot of bifurcation, but we also see the bifurcation in some really unconventional and less correlated ways than it's historically manifested.
Great. So, switching from macro to, obviously the impact of macro is that how well company that originates the consumer loans or playing in that space pivots and adjusts its business to address the potential, adverse effects of the macro issues. So from that perspective, Ivy, if you could articulate, how has Upstart adjusted or pivoted? Nancy touched on FICO inflation, where because of the government subsidies and supports through the pandemic, a lot of people's credit scores got a bump up. And what changes have you made in your underwriting, and what has been the impact on volume? Have you targeted a particular credit profile, or has it naturally shifted as a result?
Sure, happy to answer that. So there's been, I would say, two things that we've been really focused on in the last few years. One is macro handling, and two is just increasing our expected losses per borrowers across the board. And so on the macro handling side, we used to have a very, I'd say, crude heuristic to how we think about exogenous factors with respect to machine learning. And so we always knew that stimulus was going to go away and that might have an impact on the consumer. However, we didn't, that was a variable that was, again, somewhat of a crude way to apply it. And what we've done since then is something that we call the Upstart Macro Index, which is essentially a defaultiness index of the borrower. And we do some fancy math on the behind the scenes, and what it ultimately does is we're able to take the same cohort of borrowers and we control for our mix, we control for our models, and we're able then to identify what are the exogenous factors that are impacting the consumer. And so that was one of the tools that we have come up with over time to really allow us to not only continue to be very good at borrower risk separation, and that has held for really the last decade of our company, but what we missed was really the calibration of those losses due to, again, exogenous factors and really paradigm shifts like stimulus coming and going away. So that was one. Two is expected losses, bringing them up across the board, and the impact of that is borrower migration. And so we don't control for volume, we don't control for mix. All we do is every borrower that comes to the Upstart website, we apply an individual defaults and prepayment curve, and then we have a risk grade that is self-imposed, and all of these borrowers fall into these risk grade buckets. And what we're seeing now is a lot of borrowers who used to be graded an A or B grade is now graded a D or E. And so that's been kind of what we've been doing on our end. I wouldn't say to tighten underwriting, but to, one, get better on the macro side in calibrating the losses, and then two, really, losses have just gone up across the board.
That's great. Eliona, I know given the niche product or niche sector that Stratus plays in, what do your investors look for, or what kind of concerns they have when you talk to them about your product or how it's going to perform, and what is top of mind for them?
Yes, that's a great question. Considering how niche our product is, each time I approach any investor, their main question is, what's the risk here? And I always ensure, and I pretty much lead by saying that our underwriting is pretty tight. I mean, Stratus was founded during pandemic. We were founded 2020, and we started ramping up by 2021. So underwriting has always been top of our mind. We have strict underwriting requirements, and we stand pretty tight on those to this day and going forward. What I do let them know is that we look at three criteria. FICO score, which we pride ourselves on our borrowers and co-borrowers, at least 720 and above. So we're mainly prime, super prime. Their current income, not future income, and current assets. So once we do like a strict due diligence on these, I always ensure our investors that the quality of our borrowers and our co-bars is top notch. And then another question they always have, considering how niche it is, what would happen, if we have a 2.0, pandemic? And that's something that, of course, if that were to happen, it's a global issue. But I would say that would be the main risk, a huge recession or a pandemic. We stand pretty strong on a positive outlook on the economy going forward. So,
Great. So now that we have considered all this and originated the loans, I guess the next question is, a lot of times it's easier to originate loans, especially in the consumer space, because nobody is going to say no when you want to lend money to them, but it's challenging, as we all know, to get it back from them. So that's a focus. And if we think back to the GFC days, there was a saying you could live in your car but not drive your house to work. So people were defaulting on their mortgages but not on their auto loans. But based on what we just heard, people are sitting on a lot of home equity now. And so the question is, performance in the auto sector, is it going to be worse than mortgages that we saw back in the GFC? The last 18 to 24 months, subprime versus prime, I think we touched on. Subprime borrowers are generally under pressure, so the volatility is less compared to a prime borrower space. A lot of the originators I speak to in the subprime space would never, agree to lend in the prime space because of this extra spread they can make in the subprime space for the risk that they take. So, the question is, what with the resumption of, say, student debt repayments and what have you, what is the portfolio performance that you have seen sort of in the last 18 to 24 months, and how do you manage that, or what things you monitor in your portfolio as you look forward?
Sure. I think as we're going to talk about consumer resilience, I think the performance in consumer obligations that were actually securitized or held in privately financed portfolios has been interesting, to say the least, especially over the last 2 years. Especially coming out of 2020 and 2021, which kind of have generated some of the best performing credit cohorts, especially at least like all of 2020 and first half of 2021. I'm going to try to condense this as much as I can, but I'd say a few themes. First is, I think for us, when we look at the whole spectrum of consumer debt obligations, spanning from mortgages all the way down to unsecured consumer loans, almost spanning like the entire consumer payment hierarchy. And let me just even make it clear that in mortgages, when you look at GSE originated, very high FICO, full doc, high friction underwritten mortgages, all the way to unsecured consumer, some of these recent vintages, especially 2022, in some cases still 2023, there was underperformance versus the prior vintages. It was not that any certain asset class or any sub-tier actually outperformed in the 2022 or 2023 vintage versus the past. So what that told us was there was almost something systemic driving the underperformance. We can all do the attribution on the aftermath after kind of coming up with what we saw in the data. But it was unmistakable because you've kind of seen Fannie Freddie mortgages, Ginnie, FHA mortgages, subprime autos, and unsecured consumer loans all kind of underperformed poorly when we transitioned from 2021 to 23. Secondly, I think we've kind of all talked about the effects of inflation, something I think wasn't in our recent memory because everyone kind of thought of any stress in the consumer market to be associated with a stress in the labor market. And I think most models really didn't have a 1.5–2% inflation going to 8 to 9% inflation shock as a driver of consumer defaults. So, when you kind of look at the data and ultimately see whether it's a changing FICO story, the harder part, I think, to come to is saying, this was entirely driven by credit FICO score migration, because I think, I'll go back to something that Ivy alluded to. A lot of borrowers use a lot of information to kind of determine the creditworthiness of a borrower. So some of the challenges you've seen in the beginning, right at the get-go when stimulus was pulled, it was the lower income subprime consumer cohorts that immediately started underperforming. Right after now, in the last year and a half, we are seeing some of what we would have considered prime based on FICO score or middle to high income tier borrowers starting to underperform. So what's interesting is, all of this underperformance across the credit cohorts and income tiers didn't happen all at once. And then, to say the least, not only has the degree of underperformance been very different. For example, on an agency mortgage that takes 45 to 60 days to underwrite with all of the information on the taxes, income, everything being verified, still seeing underperformance to kind of, something like all the way to unsecured consumer loans where maybe realized losses doubled versus projected. It's been kind of a stark contrast. So some of that, I think, goes to what Rajan talked about in terms of consumer payment hierarchy during the GFC. It was kind of autos and cards took precedence over mortgages, and we have seen a reemergence and rejiggering of that theme where homeowners who have benefited disproportionately from wage inflation but have not had to face the same degradation in terms of cost increases, just like renters, have also kind of like ended up outperforming. So overall, there's been a lot of dispersion among asset classes, among originators of different asset classes as they have tried to kind of manage to this credit environment. And as we kind of continue to glean learnings, the more important thing is how do we address it going forward? And some of the things that Ivy mentioned, I think we've actually worked very closely with our borrowers who we lend to on the private side, where there's been a lot of a collaborative approach to this very unique credit environment in terms of figuring out what are the learnings. How do we get a better picture of if FICO scores have been inflated, what is the true credit worthiness of the borrower? Are there other things perhaps that may not be being reported to the bureaus, or are there other areas where there is incremental debt that might make the borrowers less credit worthy? So it's really been focusing on the credit box and trying to kind of figure out who are some of the better borrowers, and then trying to kind of like streamline assets going forward is what we have relied on, whether it be prime auto, subprime auto, unsecured consumers. I think that's primarily been our focus in working with our partners and identifying how to kind of mitigate risk. Where do you have pricing power? Where don't you have pricing power to account for changing risk? And maybe focusing a little bit more on homeowners versus renters, getting a better estimate of a borrower's household balance sheet. If anything, averages have been very misleading throughout this cycle. So when we talk about income increases, cost increases, auto insurance premiums have gone up by almost 50%. So all of these things, looking at headline CPI numbers, I think those are all helpful guidelines, but we've definitely found it informative to kind of dig a little deeper and try to work on that on a prospective basis.
Right, that's a fairly comprehensive analysis. Ivy, in the context of what sort of articulated, I know you mentioned Upstart uses its own internal index. Has that shifted in this last recent little while with the performance, and how has it changed?
Yeah, absolutely. Just to add on to what Saurav said, the Upstart Macro Index that we track, we can also bifurcate that by different variables such as FICO and income. And so when we look at that, there's we see that divergence that we've been talking about here around prime, near prime, subprime. And again, just I think to quickly recap, in 21, 22, we saw that subprime degrade very quickly, and that's when, again, our hypothesis is that the stimulus went away. That's the cohort of borrowers that was immediately impacted, and throughout 23, it flipped. The subprime, near prime borrowers stabilized, and then it was a prime that was impacted. And again, we think that's somewhat behavioral, perhaps. And very thankfully, I think in the second half of 23 and throughout 24, we've seen at least both start to stabilize. Not only that, we've seen the subprime, near prime borrowers, at least within our portfolio, really start to nosedive in terms of the UMI. So our UMI lower is better, higher is worse. The reference period is 2014 to 2019. So a 1.0 for us is that benchmark period, and we're seeing on average things our defaultiness be at 1.5. So for the same cohort, our bar is about 50% higher in terms of losses. But if you break that out within the near prime, subprime cohort, it's actually starting to revert to the mean. And so I think that speaks to what Sarah was talking about around that bifurcation and looking at bars within a cohort.
Cool. Jason or Nancy, anything to add?
Well, I guess we look at it probably in a more fundamentals-oriented way, bottoms up, as opposed to a model-based approach in our own work. And I think this is one area where a bottoms-up view has worked well. And just to kind of give you an example, if you think about a consumer today, and a type of near-prime consumer that we might serve, their rent is up about $300. They're now paying their student loan. That's getting reported to the credit bureau as of, a month ago. That's $270. Their car payment is up $200. Their credit card bill is up $100 because of the higher rates. And you tally those things up, the average person's spending $800 to $900 a month more if they have those expenses for no net change in their standard of living.
Not to speak of the increase in food prices.
Ignoring food, ignoring electricity, ignoring kind of all the other consumables. And that's roughly $10,000 a year. And so when you think about that from a credit perspective, that's probably 15 or 20 points of DTI and probably 25 points of DTI post-tax, which is an enormous impact on what forward credit performance will be.
I'd say from our perspective, it's another reason we've been very focused on homeowners and looking at home improvement products in particular. And within that, we've built models that are what I'd call ex-FICO. So the models, we'll take the model and then take FICO outside of it times FICO and try to sort of look at twin pools, all things being equal from a FICO perspective, to figure out who's going to perform better. And that's been very powerful in thinking about. And it's things like when did they last take a mortgage, all kinds of different things. So I think that's been a key piece. And you talked about hierarchy. We did a lot of work on this too. Auto is still number one, then house. Then you get into credit card, unsecured debt, and student loans are typically sort of at the bottom of that because you have your student loan. It's not like if you default on it, they're going to take your degree away at this point in time. It doesn't have the same impact as if they take your credit card or your auto or your home away. But I also think we're going to see over time the impact of all of the learnings of borrowers and consumers from some of the changes that have taken place. The GFC with foreclosures taking 10 years at a time. And then, when the pandemic hit and having everything forborne. So I think people learn that and expect that for the next time around. So it's going to be very interesting to see how it plays out. And in the meantime, we've been always focused on secured versus unsecured, up in credit, whether it's FICO or not. And as I said, when we did the work on the what's gone on with consumers, actually the sort of top 50% of consumers are in better shape on average. Again, there are areas of that where it's not true than in the past, just based on wage inflation as well. So it's going to be interesting to see how it plays out going forward.
Yeah. So I guess, feels like as a collective finance company or investors in those businesses, you got to be on the ball and keep your eye on what is coming in the door and keep your eye on what you're holding and monitor it and manage it, as opposed to, being asleep at the switch and let it, or hoping that it's all works out. So switching gear, I guess the other aspect with, we have talked about the asset side of the business originating these loans. Let's switch to the funding side. We are at a private credit conference, I guess. So, as we look at funding side of things, you have a variety of funding sources, be it your own equity, maybe a warehouse line, maybe public deals. And I think, Ivy, as we were chatting before that, you're coming to the market or potentially coming to market, after a while on the public side. So, even on the funding side, it could be the public market or a private deal. How do you look at, your funding side of things, and what are the things you consider when you look at a potential partner on the private side, and things that you try to manage your liquidity?
Yeah, thanks for the question. So part of what, in addition to macro handling, underwriting, we've also spent a lot of time, especially on my team on the capital market side, on what we call risk capital, more like structured forward flow. And so that has, we've seen an influx of more private credit, private equity partners come into that space. And I think we sit in a unique position where we are offering, a pretty juicy ROA once you lever that out, that hits their, the bogeys that, traditional private equity players are looking for. And so we've really built, I think in the last year and a half to 2 years, a resilient capital base, and that was something that's new for us. We used to just have at-will capital on the platform, like a true marketplace, uncommitted. And so now we also ourselves have skin in the game, and these are more structured transactions where there is downside protection, but there's also upside for us as we effectively have that residual position in these private deals that we are doing. And so with that, as we're heading into 2020, end of 24, 2025, and there are more tailwinds, we're pretty oversubscribed on that capital base, and that's something that we're very happy to have built that resilient capital base, and that is also partly why we've been pretty quiet on the public ABS side. That is the UPST shelf that we offer is much more of a service for our forward flow buyers, and these are buyers that have now become more buy and hold, at least the composition of our borrowers. We do expect that to change. There are contributors on our platforms that are now coming back into the market to diversify their funding, and we're also expecting at-will buyers to also come back, and they're a little bit more reliant on the ABS market, so we do hope to come more frequently to market on a quarterly basis.
Jason, how do you look at funding and liquidity and diversifying and managing that through cycles?
Yeah, no, it's a very good question. And company's been around for 25 years, so we've seen both the good and bad of those cycles. Today we are resolutely an asset-light business. We sell through 144A, 4A2 placements. We sell through forward flow. I think one of the tensions in any business like ours, and especially finance, is you want to diversify your funding streams and have that benefit from a credit perspective. From an equity perspective, though, what most investors are looking for is a binary story. Are you asset light or are you a balance sheet company? And those two elements are just a tension that needs continual managing. It's not something that gets resolved. And so the way that we manage it is we look to maintain an asset-light model, and then we look to meet the market by having a more conservative credit box. If we could originate through our natural funnel, we could originate $1 billion. Maybe we actually only originate half that amount so that we can ensure that our investors receive the returns they expect. There are no surprises, and that then provides a measure of certainty that they'll be there for us for the next round, for the next funding need, even if the markets are a little bit more volatile. And we've worked very hard for that reason to build relationships where we've performed for our investors over long periods of time, and they have that confidence in us.
That's great. So, Jason, JG Wentworth, and Upstart have been around for some time. Eliona, like Stratus is relatively new, so how do you look at, your investor base and your source of capital right now versus other funding lines that you may be looking at? How do you think about it?
Yeah, so again, we are a pretty niche product out there, a pretty niche company overall. So as initially, our funding started by, our two partners who pretty much, they're both in the flight industry and one of them in the law firm. So we felt pretty confident in the beginning with knowledge base and funding base to start, considering how much of a gap there was in the industry. Once we did the self-funding, we had some bank partners. We secured some line of credit, and then we're talking to some institutional investors for forward flows and other type of product.
I mean, it's always interesting. I mean, I think, funding side, it's always good to start talking to other sources of liquidity when you don't need it, as opposed to when you're in a crunch and you need it. So, as they say, banks always lend to people who don't need the money. So it's better to speak to diversified sources of liquidity, which is what this conference is about. So yeah, that's what we hear from our originators on the panel here. I think we had the first poll. I don't think we touched on the results, and I think the top one seemed same level of uncertainty prevails. Okay, so this is like, the guy goes to the tarot reader and says, can you tell me what's on for next 3 months? It's doom and gloom. Oh, after that, you get used to it. So it's the story of that. We all have gotten used to the uncertainty, I guess. Calmness returns. Oh, that's 27%, not insignificant. So those are the optimists in the room here. So that's great. Finally, to wrap things up, a few other things. So I think maybe this is directed more to the last three panelists. Fraud, I mean, with AI and things such as those that you hear, and Equifax and others put out these studies that it's been going up, and it could be done by the obligor or borrower, underlying borrower themselves, because they present some false statements, or it could be, if it's an auto, car financing, it could be done by the dealer who is the intermediary and things like those. So, if you, Ivy and Jason, if you could touch on how you, how big of a concern is that, or your experience, or things you have in your, as part of your underwriting process to kind of avoid it.
Yeah, sure. I can kick off. We have an entire team dedicated to fraud. It's something that is obviously incredibly important to make sure that we actually try to catch it before it even goes to sale to our forward flow buyers. So, I mean, we have seen a slight uptick in fraud, but it's also correlated with the increase in defaults just in the last few years. But again, I think they're somewhat isolated attacks here and there, and it's really just, I'm very happy to say that we have a dedicated team of engineers and also just credit folks all the way up to our CTO, who handles a lot of the fraud that does or does not come through. But we've also gotten a lot better at it. Partly because we've spent a lot of our time on technology, automation, and that's how we kind of handle those type of situations.
Okay.
For our products, we tend to focus more on products where we've had especially for credit, where we've had a relationship with the consumer in a different context for some period of time, and that helps to mitigate fraud. And I guess what I'd share is, From where I sit, the most pernicious fraud right now is not the third-party fraud that most folks think of. It is what we've taken to calling FICO fraud. There is a class of companies out there that are systematically looking to effectively corrupt credit bureau records to show that a consumer is a better credit than they are, and they're charging the consumer for that service. There's some number of there are a lot of credit builders that operate in a very legitimate way, helping people build their credit. There are other folks out there that are distorting trade lines, distorting utilization, distorting payment records. There are lenders, of course, that they will report a hard pull if they approve someone, but won't report a hard pull if they don't, which really diminishes the usefulness of assessing how credit hungry someone is. So there's a raft of behaviors around credit reporting bureaus right now that is I think just really harmful to being able to do what we all do up here in trying to assess consumer credit risk. And I'm hopeful that the bureaus will start to take more effective action to maintain the integrity of the files.
It's great. I think we are running out of time here. Any questions from the audience? Couple of quick ones. Please go ahead.
I'm Shrikant. I'm from Experian. Some of you use our data to make these decisions. One question I have is, what kind of consumer asset classes are you seeing the private credit firms being most interested in? And then second, what are some of the, as you work with them with the partnership, what are some of the things they are asking from you that's yeah, I'll just continue. What are some of the challenges in deal making that could be overcome, right? Is it data? Is it analytics? What kind of things that would help to make the process less friction?
So I'll start with what assets we're looking at. And we do use Experian Sandbox, so thank you for that. It's a great tool. And what I'd say is I don't think the assets have changed that much. It's just where they're coming from. So we're seeing a lot more SRT, CRT transactions coming off of banks where we're going, very heavily working with banks on their risks and what's happening with Basel III. So what we're seeing is, a shift from what were traditionally bank-heavy products and some movement of risk into private credit. So we're looking, across the spectrum at every type of deal from that perspective. And then also, as we gear up for what we think will be a wave of bank M&A, banks will, once they can get purchase accounting, have a place for some of the consumer loans that are at very low rates, mortgages in particular. So we're gearing up to buy those as well in the private credit market. So I'd say it's not necessarily new assets, but just new ways of delivering those assets is what I'd say. That's helpful.
Yeah. The way I took your question to mean is that I think for us, for example, we've been kind of involved on the private side with originators across the board, from deep subprime credit cards to debt consolidation loans, point of sale products, RV loans. The thing that makes it challenging at times, especially if you don't have a lot of historical data, is coming up with proxy data. That's when times are good. But over the last 2 to 3 years, what made it very helpful, I think some of the things kind of, Rajan, you asked about, was fraud. Across a bunch of consumer asset classes, without being too specific, I think we actually saw a pickup in early past dues across the board, whether it was point of sales, whether it was unsecured consumer, secured products. And one of the things in terms of working with our partners, who are the originators, in tamping down risk was hitting back the bureaus with figuring out what was going on, doing reject inferencing on the population that actually demonstrated early past due behavior to see is there further credit seeking behavior. So those are sort of I think the data, call it interactions we have with our partners who on the other side who we provide liquidity to, where either I think credit is in a transitional period or an inflection point like it has been over the last 2 to 3 years, and then really trying to get more information. Everyone's talking about FICO migration and what effect it had, but trying to figure out where the hidden variables are, because the creditworthiness may or may not have changed if it's not reflected by FICO. What are some of the other revolving debt attributes, so on and so forth. So I think asking and getting more data on that front has been very important for us in continuing to provide liquidity to our partners, addressing these credit challenges together in a strategic manner.
Thank you.
Year, there's been about 45 million Americans with student loan federal debt that have been on vacation from making payments. And one of the things that concerns me, and I'd be interested to hear what the credit bureau has got to say, the Biden administration convinced these guys not to have to report to the bureaus. And now they just announced about 10 days, 2 weeks ago, that they're not going to start collection efforts that were supposed to start October 1st until after January 1st. And for those of you that have other asset classes, my concern over the last year is how the hell do you make a decision on credit if you got 45 million Americans with 1.7 trillion in federal student loans outstanding, you know, and how does that impact the auto loan or the house, you know, mortgage stuff? And how's it going to impact? Because I think we're going to see a lot happen come, you know, March or April, when the 40% of the people that haven't made a dime in a student loan payment since March of 2020 have got to pay their federal student loan, and 10% of this crowd has got two loans. They got a private loan and they've got a federal loan. So just some thoughts on your side.
It's just on that one, private loan, I guess, is not part of the deferral and, you know, the government plan.
No, but the fact of the matter is they're going to have to go back into repayment because now they're going to get collected on, now they're going to get reported. And so how is that going to impact, you know, what happens next year?
Again, if you look at the waterfall of payments, student loans are at the dead bottom as far as what people are worried about paying back. And that doesn't mean that it's not going to impact credit when they do have to start paying them back. But I do think another element that a lot of people aren't talking about is at this point in time, the payments that are going to come through are kind of pay what you can, right? So if that changes with a new administration or something else, then you might see an uptick. But for the time being, even when payments resume, it appears as if payments are resuming on a light basis and more of a, okay, pay what you can afford.
We'll know more about that on Thursday this week because of the Court of Appeals and the 8th Circuit's going to hear the oral arguments on what you're calling, which is the SAVE program, which is the point that you're making. So you're right. I mean, it's going to be very interesting as to what happens in that case.
Jason, I think you had something there.
Yeah, I'd offer maybe a slight twist on this, which is from where we lend from multiple years. You know, our average loan is 4 years and change. Average duration is over 2 years. I think it's incredibly risky to think that over that period of time, that someone who is not paying their bills is going to pay our bill, and systematically not pay other bills. In general, if people are paying their bills, they're going to meet their obligations. When they're not meeting their obligations, that's when a payment hierarchy starts to come into play. But that's a fairly narrow window and fairly narrow slice of the population versus the broad set of folks that you're looking to lend to if you're lending on a term basis.
Yeah, I think I'll just add one thing very quick to what Jason and Nancy said. I think, as Jason pointed out, I know the metric is 45 million Americans. I think what we've done, and I think goes to what Shrikant asked, there's a possibility of actually identifying from the Bureau people who have outstanding student loan amounts and have they been paying it or not. And I think that varies between different kinds of population. Like there might be certain subgroups who are basically, like I think so the concentration of those borrowers is something that, you know, I think there are some ways to kind of like try and estimate that. And I think, as Jason pointed out, overall, it's still kind of a smaller slice. There are possibilities of trying to mitigate that risk by trying to add that amount in to figure out who may or may not make it through the DTI or PTI cut once you add that potential payment. So it's an incremental picture that you can create for a borrower by digging a little bit deeper through the Bureau data to say, X number of people have student loans, what is the likelihood they're going to pay that, but what is the excess amount, how does that compare with the rest of the outstanding, and say, you know what, if they were marginal, maybe you don't make that credit decision. If they are not, and they have sufficient cushion, or they have like a very strong picture in terms of other credit-seeking behavior, then you might get comfortable. Like, I don't want to get too much specific because I'm not an originator myself, but these are some of the conversations we've been having with our originators who we partner with on the warehouse side to determine and kind of quantify the risk, because, you know, as you're still kind of long some of these assets or originating into this environment, I think it is important to kind of like add that picture and complement it with whatever Nancy and kind of Jason said. So.
All right, I think we went a few minutes over. Thank you, panelists, and hopefully everybody enjoyed the panel and the talks, and thanks you for your attention and attending.
Thank you.